This Saturday, thousands of people will head over to Churchill Downs, the Twin Spires, for the 143rd renewal of the greatest 2 minutes in sports, you know it, the Kentucky Derby. This year's race should be a lot of fun to watch. There are several potential winners, a few feel-good stories as always, and there's always hope that we might see one more horse take the elusive Triple Crown. And there's something else I've noticed. There are several key parallels you can draw between the sport of kings and, believe it or not, portfolio management. Here are 3 investing lessons you can learn from the sport of kings, horse racing. First, you should understand that, like horse racing, investing can be a long race. Like jumping onto the first hot trend you see might be tempting, but how many times have you seen, like, for example, a horse get off to a great start only to fade somewhere along the way? Or maybe one of them stumbles out of the gate, but by sheer will of a great jockey manages to finish in the money. The point is that acting on the short term can have really bad consequences over the long term, and it may be better to take the long-term approach and maintain an even keel throughout the race. So the second is, don't assume that recent champions like jockeys will always stay in the winner's circle, like money managers. Oftentimes, investors will look only at certain sectors or stocks or funds or managers that have managed to outperform the markets in recent years with the hope that they'll keep winning. But it's important to remember that investments on Wall Street tend over the long run to revert back to the mean and fall back in line with their long-term performance. So the hot sector today may not necessarily be the hot sector tomorrow. You might try taking a broader view of the market and staying diversified. So third, you should have some analytics to guide you along the way. In horse racing, believe it or not, there are teams of professionals who spend all their time evaluating each horse, looking for signs of strengths or weaknesses that would not be obvious to us amateur racing fans. From this information, they compile all this data, which they then can determine if the price of entry represents good value. As an investor, you should rely on guidance from professionals who might be able to identify that good value, as well as to help you through the market ups and downs, through your wins and losses. And just like there are different track lengths and conditions for horse racing, not all stock market environments are alike. So this Saturday, here's what I'm going to do. I'm going to sit back. My wife's going to put on her big hat. I'm going to sip a mint julep, and away they go.